All right. So I'm just going to go over my thesis on Google, why I believe it's a buy, why I believe it's undervalued, and why I believe a lot of people are discounting it and its growth. Um, so yeah, this is just going to be all off the dome, I suppose. Maybe 20 minutes of just me talking, and I guess I'll just get into the valuation models I use first, and then I'll get into the more qualitative aspects. Um, so yeah, you can see my summary here, starting off with just a simple multiples model. I got about 203. I'll go over all of these after I say the price, but as you can see, I got 203 for that, 197 for a gram model. Price to books adjusted multiple. This is using return on equity to adjust price to book value per share. I got about 222, and then a depreciated earnings per share model. I got about 328 after 5 years, which is very generous for the growth rate that Google's seen in the past and with AI in the future. But yeah, this is generous. Um, Overall, that gave me an intrinsic value of about 235, which is definitely an upside from what it is now. And when I did it a while ago, it was even more of an upside. Applying a 15% margin of safety, we still have a value of about 200, which is a 20% beating the market by about 10% because S&P returns about 10%. Analysts seem to agree. I just like putting this stat here because it's nice to see that other people like agree with me. Um, so yeah, I've got those targets right there, just good estimates. I'll go over the models now. So for my multiples model, I just use the analyst 2026 earnings per share estimate. I get all my stuff off of either Seeking Alpha, Qualtrim, Schwab Analytics. I kind of aggregate all of them, and I find whatever has the lowest value, and I'll use that in my assumption because that'll be a conservative estimate. So yeah, I went down also. I found the price to earnings of the whole industry. Google obviously trades like less than the S&P 500. I think the S&P is at about 20 or 23 right now. But yeah, they're trading less than the S&P 500 and far less than their competitors in the AI space and other big tech. Um, so I just took those, I averaged them out, found the mean. I found the forward PE of Google, which was about 16.23 at that time, and then I found its historic forward PE, which was about 25. So again, trading at a severe discount. And if I just averaged out the industry, the forward PE, and the historic PE, it's about 25. Um, and even then, if we're going to assume that Google has slowed down and they're going to slow down, which again, I don't believe, I'll get into that later. But even if we do that, we get a PE of about 20 just by discounting it by those thoughts. Even then, severely undervalued. I mean, if we adjusted this to just say what it's been trading at for the last 5 years, its forward priced earnings, it has a 51% upside. So really, this is very conservative, and it's still a buy. So that's that model. These get a bit more into it, and I like putting Graham's number up here simply because it's a good estimate of the book value of a company, but it's not too helpful with tech companies as a lot of their assets are intangible, and a lot of their return is going to be off of intangible assets. And so this doesn't really take that into account. It kind of just takes the book value. But even with a tech company, a Graham number of about 50% down really isn't that bad. But I mainly ignore this as it's just a fun thing to put up there. So I went into Graham's model here. This model particularly for Google. I factored in about 1.5 times growth rate. I guess actually, let me go down the whole thing first. So the earnings per share, I just took the trailing 12 months. Should really put that there actually. There you go. Trailing 12 months earnings per share, about 8.87. I took the price to earnings of a company with no growth, which for tech might be a little bit higher than 8, but it's, about uh, 10 to 15, stuff like that. But I took 8. So I took that. And then I also found this 11 simply by going to Qualtrim, going to Schwab, Seeking Alpha, looking at the revenue growth over the past 5 years, earnings per share growth, free cash flow growth. And honestly, it was higher than 11. If I can go back here, we can find some of their growth statistics. I don't think I put revenue here. That's unfortunate. Well, there's free cash flow per share. You can see over the past 5 years, 23.65. I guess you also see right here, earnings per share 27.5, revenue 16.7. So all of those for the past 5 years, significantly over um, 11, but let's discount it to 11 to stay consistent. Um, Even if let's say actually we did bring it up to about 15, which is less, it's an incredible upside. So again, all these models are conservative and they're still upsides, which is why I believe Google is one of the most undervalued companies. And frankly, I don't know why it's not being talked about. Well, I mean, it is being talked about. It's under a lot of fire, but I'll get into that later. Again, I applied a growth model of about 1.5 growth multiplier. If you apply a 1, there's just no expected growth of Google. So we're saying that it's just going to stop growing entirely. So if we gave it a 1 right now, we have a downside of about 10%. And this is assuming that Google's not going to grow. So I don't believe that. I'll get into that again later. But if we apply a conservative 1.5, it's a buy. If we apply the expected growth rate in Graham's model, which is about 2 for tech companies, we get a 43% upside, which is, again, very over what it is right now. Um, and yeah, I took the average yield of a AAA corporate bond, it's about 4.4, stays consistent around that. And then I just got the most recent 20-year AAA corporate bond yield, which is about 4.85. I think the two I looked at were a Microsoft one and two Microsoft ones and one other one. But I took the average of those yields and got about 4.85. We plug it into the formula here, and we get about 17% upside on Graham's model, which is very nice. So it's a buy for that model. If we look at the price to book industry multiples model, for this one, I simply just took price to book of Google at that point. I took its average return on equity, which is justified, and I'll get into that down here. But I looked at its return on equity. It was about 30%, I think 35%. I took its book value per share. I took its 5-year average price to book ratio. Simply looking at the last 5 years, its average price to book. And I took that, which is actually higher than its price to book now. And then I took the competitors, excuse me, sorry, the competitors' average price to book. This would be I took Google, Amazon, Apple, Nvidia, Microsoft. I believe this one of these is here in Microsoft, but I think Apple, Nvidia's I think is 47.4, which is kind of crazy, but. Yeah, I took the average of those. I didn't really plug them in up here like I did with the price to earnings model, but I just kind of looked at Schwab and got those. So yeah, I took those, I averaged it out. I got about an 18 for the competitive side of it. I mean, this is tech, so price to book is really going to be skewed since a lot of it's intangible again. Um, but yeah, and then I went to the S&P 500 price to book, which is about 5 last time I saw. Google's retention ratio, they just started a dividend, which is nice. That's an interesting point too. They started a dividend because now they're investing even more into AI, but they're also distributing a dividend, which, I mean, how much cash do they really have? That's kind of crazy. Anyways, retention ratio is about 91%. And so with that, that gives me a kind of justified return on equity of about 30% because Google shareholder equity base has always been high and it's always averaged around 25 to 35% for the past 5 years, with substantial growth or continued growth, I would say, throughout those years of it going up. Um, and then I just took this and factored it into my growth in the book value per share, which is going to affect the final model. I just took the retention ratio, multiply that by the justified return on equity, which is going to give me what the book value per share should actually be, not just what it is right now. And that gives me an adjusted value of about 36.3. All we do is we simply take the book value per share, or we take the average of the 5-year price to book, and then it's price to book now, just to say conservative, and then we just multiply that by the book value per share. It will give us price, and I got about 32% for that, which I'm happy with that rating. Obviously, I'm very happy with that. And then we get to the depreciated earnings per share. Not too familiar with cash flows. I need to learn that, so it would be a useful one. But for now, we're going to go with the depreciated earnings per share, sorry, not depreciated, discounted earnings per share model. What time am I at right now? Let's see. 9 minutes? All right, we can keep going. All right, depreciated earnings per share, or discounted earnings per share model. Um, so I got the trailing 12 months earnings per share of about 8.97. 2026 estimate, we got that back in the regular multiples model. Um, that gives me an estimated growth between now and 2026 of about 13.5%. And then I took into account its 5 year historic growth rate, which has been about 26.73. I averaged those two out. And then I kind of just came to the conclusion that I'm going to discount it by 5% because let's always discount it and be conservative for the sake of valuation. So we gave our earnings per share growth rate of about 15%. And that is what we're going to end up using for the discount rate when we eventually do, or not the discount rate, it's earnings per share growth when we calculate the projected over 10 years, which is exactly what we do here. I don't know if anyone's familiar with how we do this, but um, we're just multiplying this by 10%, 10%, 10%, 10% all throughout 10 years. This is the current price to earnings ratio. And then I gave a good base of what I believe it should trade at, which is 20. Honestly, it could be even a little bit low. But we gave that. We ended up getting a projection like this. Most discounted models look like this. So that's a good sign. Um, I got this terminal price to earnings ratio back again when I think about this part here. When I said a price to earnings of company with no growth was 8, I was conservative with it here, but if I go back even more, or not if I go back more, but if I again look at this point over here where it's a high quality stable company, which I believe Google is, it should be about 10 to 15. So I took that into account here. I just gave it a 12, um, which is a good point there. And then the risk-free rate I found was about 4.43. That's just the return of I believe a 20-year bond, 20-year corporate bond. Let's see. I believe it's a 20-year corporate bond. It's either no, actually no, it's 10-year. I believe it's 10-year. So the yield right now of a 10-year corporate bond, which at that point was 4.43. It might be 4.44 right now. It's very close. It doesn't fluctuate much. But yeah. And I took the beta of Google, which surprisingly is 1. I think it might be 0.99 now. Again, fluctuates very little, but it's about 1. Um, and then I just found the market risk premium. So the S&P's returns of 10% minus the market risk premium, again, which is just the S&P returns minus the risk-free rate. This is the risk that you're taking when investing in the market on a cash flow basis. And then I found the discount rate just by taking the risk-free rate and then adding it to the beta times the market risk premium, because this market risk premium times the beta is essentially telling me how volatile Google is going to be, which really it's not telling me it's gonna do anything because it has a beta of 1. So really this is just the risk-free rate added to the market risk premium. So the discount rate we're giving it is 10%, which is the same as S&P returns. Um, so that's what we're discounting at. We're assuming that that's going to be discounted. Um, and then we took the terminal earnings per share growth rate of about 4%. Usually it's about 3 to 5% for a stable company. So we took 4%. And then the year 5 growth, or the year 5 value, if there was no growth, so going off this terminal PE value, would be about 216.50. But that's over that whole period if there was no growth. So we take that into account when we're finding our present value. Again, we're just taking these values up here and we're discounting each of them by that 10% one time a year, the present value function. It'll give us these values. And then a little thing that I did, I don't know if people do this, but I took its current price to earnings this year, projected it out 20, and let's say after 5 years it stops growing, goes to 18, 16, 14, and then the last two we have about 12. So this is the terminal value that it's reached. It's not going to grow anymore. Um, we still getting a pretty nice projection here of it going up consistently over the next 5 years. And that would end up giving us our value at the 5 year mark of about 328 based off these current assumptions that it's going to grow at, which is about a 95% upside in those 5 years. So that's that part. I haven't quite gotten to the financial statements part yet. Um, I would like to, but this is a lengthy process, so we're gonna keep that out of it for now, for the sake of time. I'll just go over to my thesis. So let's start with just a cash flow yield. If we're just looking at this at a cash flow yield, I like to do this with every stock. If Google has a current yield right now of about 3.6 on a cash flow basis, we can find that. I find that by going on Qualtrim and look at cash flow basis or cash flow yield. Um, and it has an average growth rate of about 18% in the past 5 years. Again, I say let's be conservative and bring it down to like 10, which is incredible since it's slowed in the past 2 years. The risk-free rate, again, that's 10-year return of a bond. That's going to be fixed because it always is giving you that 4.4% over however many years you have it, 10, obviously. I don't know why I just said that, but yeah, over 10 years, it'll always be giving you that return. Um, well, over that time, it would take Google about 3 years to surpass the return of that bond on a cash flow basis. Because when we're looking at cash flows, the bond will always return you the same amount of cash because it's a fixed income. But however, when we have a stock, it can grow, which is what we're factoring into here of about 10% a year. And we see right at this point right here, 3% is where we cross that threshold of the return of Google being on a cash flow basis, obviously, greater than the bond. So I'm going to get into just some more of the qualitative stuff. So positioned at the forefront of AI integration with one of the leading models, and I believe that integration is where the money is going to be made. And Google is heavily investing into AI infrastructure along with the other giants. The CEO said that infrastructure is a necessity, and this furthers the notion that Google is committed to investing and returning high margins on AI products. Additionally, I want to add that. I may have even counted Google out in the total AI race. I believe that every model was the same, but after today, I'd like to show you this little video. After today, we found out that Google released so their new video model, which is just take a look at this. I mean, this is incredible.
How much wood would a woodchuck chuck if a woodchuck could chuck wood?
How much wood would a woodchuck chuck if a woodchuck could chuck wood?
We can talk.
No more silence.
Yes, we can talk.
We can talk.
We can talk.
We can talk with accents.
Oh, I think that would be marvelous.
Yes, it is very fun. But
Yes, it is very good.
It's very fun.
I can talk.
This ocean, it's a force, a wild, untamed might. And she commands your awe with every breaking light.
They left behind a ball today. It bounced higher than I can jump.
What manner of magic is that?
Yeah. Oops, I didn't mean to do that. Anyways, that is kind of crazy. I counted Google out. I thought that every model was going to get to the same point now. And really, they still can do the same stuff with research and deep research and citing sources. They all do the same stuff now. But that is kind of crazy that they were able to create that model. And that is the leading model right now, I believe. I don't think there's any other video that does better than that or looks better than that. So yeah, I counted Google out on that, which is just even something more that discounts them. Anyways, continuing on with this, Google's been trading at a PE ratio that's reflective of Walmart, which is a far outcry from its industry average and competitors. Like I said, it's trading below the S&P 500 price to earnings, and it's being discounted by basically everyone. Google owns largely profitable businesses, and not only that, they turn those difficult business models into profitable ones. So you even think of YouTube, which is highly profitable now. When you look back on YouTube, it's millions of data going in. Where do you put those servers? How do you process all the videos that are getting uploaded? Like millions a day. How do everyone get paid? It's a difficult business model when you think of it to generate revenue, but they turned it into just a cash monster. Just incredible growth on it. If you could look down here, let's see. YouTube ads is this light orange part right here. You can just see consistently over every quarter, maybe flattened out right here, but almost every quarter ticks up and up and up. It's really incredible growth that they're able to accomplish there. And then the same thing with cloud operating margins, which made an insane turnaround, which again demonstrates the ability that they can turn difficult business models and challenges into highly profitable ones. If we look at the cloud operating margins here, at one point in 2019, they were down to losing about 60% of revenue, and they just completely did a 180 and flipped that in 2023, the first quarter, and it's been growing ever since. Even if it flattens out, a 20% margin on cloud is very remarkable, as their margins right now, I believe, are about 30%. But yeah, it's incredible. Anyways, going on to the next thing, all its price to earnings, earnings per share, and book value per share estimates that I used, I believe are justified due to its historic trading levels and return on equity. Like I stated before, with a return on equity, I believe it's justified because of its average trading and or what is it? What is averaged at the last 5 years, and what it's and that Google's shareholder equity has always been greater than its liabilities. It's always been high, which justifies that even more. It's not like they have a low equity base. And then if you look here again, if you just draw a straight line on about where the average is, it's about high 20s, 28, maybe 30. So yeah, I believe these are more than justified, and honestly, could even be low, honestly. Um, but yeah, going on to the next thing over here, also you can see that I believe this is yeah, this is the return on equity. You can see it consistently has grown. I would say more pretty good on what return on equity should be annually. A lot of return on equity can be all over the place if equity based changes and shares are diluted or more shares are added. But Google's consistently grown it, which is just always nice to see. Again, with its earnings per share, you see this just exponential curve, and then also the revenue by segment, like I showed before. So I'm going to get to the final parts here. Google has a payout ratio of about 8.92%, meaning they retain about 91% of their earnings, and then that is cash that is reinvested directly into highly profitable businesses and improving the AI infrastructure. And so I also tried to think of some possible challenges they might face, which I'll go over the last two first, and then the first one, because the first one is the biggest one. So number two, the expected slowing of business growth, and while people price this in, and while the expected growth has been priced in to be slower, I just don't agree after what I showed you there. While past performance isn't indicative of future results, the track record of Google being doubted and surpassing expectations is overwhelmingly positive. And additionally, I believe that in this new stage of AI, firmly investing into infrastructure, they're going to prove that they have an incredible ability to flip marginally low or negative businesses into highly profitable compounding machines, like they've done with YouTube, like they've done with cloud. And I think they're going to do it again with AI, and they're going to do it better than ever because of all the information they have on you and how they can integrate that into AI. For the third one, expected power costs due to increasing AI infrastructure. I mean, this is a concern with the general population and not just Google, but it is definitely a concern. Because it's definitely something to take into account too, and it's found, I don't really have the answer for this and the power costs, and I would have to get someone else's opinion on this, but from my short AP environmental science class that I took, the one of the most interesting things I found there is that throughout history, I think there's been about 7 or 8 times humans have always reached their carrying capacity, and some spark of innovation happens and they are able to live on and repopulate. It's always happened, and I have no doubt that it'll happen again. I don't know how, because I'm not a scientist, but I believe that it will happen again, and that it's obviously a big worry, but I think I'm going to be comfortable in my assumption here. And then I'll get into the number one, which is obviously the biggest one, the increasing presence of LLMs like ChatGPT that could disrupt search revenue, which is about 50% of the revenue, as you can see right here, Google search. Actually, nearly more than 50%, which is remarkable. But yeah, my rebuttal to this is that Google is a serious competitor in the LLM landscape with Gemini 2.5, and they have one of the best positions for integrating it, again, with all the info and data they have on people. And that's where I believe the future profits can be made, since nearly all LLMs do the same. And I think while it is true that an Apple executive said that Safari Google searches on Apple devices are decreasing, overall search queries have increased according to Google CEO. So just not on Apple devices on Safari, but on Google Pixels, Samsung's, every other device. And then additionally, queries are another aspect of AI integration, with the CEO saying in a recent interview that we also just figured out today in their demonstration, that they're going to be bringing into an AI mode, which has kind of a full stack, comprehensive looking AI structure like ChatGPT's, and really it's transforming Google search. So it's going to be an interesting time to see, and if they can be profitable with that, which I believe they will be. And again, their searches are. The CEO said that their searches are becoming more in depth, more accurate, and containing an AI overview that is always improving with every new model that releases. Um, so yeah, we can also see just earnings per share growth. I think I put this down at the bottom, but yeah. Anyways, Google has a current 30.86% profit margins, which gives them leeway for risk and cutting without damaging earnings much. This is a good margin area because it's a tech company. They should have high margins. But my belief is that Google is a compounding machine with a justified return on equity and growth prospects. It's still very present, the growth prospect. And based off of May 18th, 2025, which is when I did this assessment, they're expected to pass the risk-free rate in about 3 years. And not only that, Google nearly always beats on earnings and revenue every quarter, while also growing free cash flow per share consistently, as you see right here. The green means they've always beat the estimates, which which is it's funny to see because when you look at a company that has priced in uh, the growth going down every single time, and they always surpass it. It's always funny to see that it still happens, but it's a good opportunity, I believe. Again, you can see the free cash flow per share growth, which is pretty good. And with all that said, I think that Google is a buy today, not only for its undervaluation, but also for the fact that its growth is trading at a discount. And the idea that it's a mature company is absolutely crazy to me. While they have been around for a while, the data shows that they are far from done, especially with AI technology, all the integration they can do, and all their moonshot bets as well. They also have YouTube, which is a great revenue source. They have the cloud. They have Waymo, which is one of the most underutilized underrated aspects of them right now. And while it's absolutely zero part, yeah, other bets, you can't even see the color. You see that little sliver on the top. While Waymo is that amount of revenue, the robotaxi industry is definitely an enticing one and not something to be overlooked upon. And Waymo is the leading one there. They have the model, the proven model that works, and that's a good asset for Google. Just another bull case for them. And really, the bear case for them is just search revenue and how that can be affected. But I don't believe that they're going to be impacted. I think they're not a company looking at the CEO's interviews, that's just going to sit down and wait to be disrupted. They're actively moving, as you just seen today, with their new video model and new AI search, just as Google. That's been integrated. I don't believe that this is a company that just sits down and waits. It's a still a growing company. It has growth prospects that are underrated right now, and I think it's a buy. And I think this intrinsic value could honestly be even higher based off of the models that I've calculated. So yeah, that's my thesis on Google. I'll be going over a few of these companies that I have. I need to do them, but I'm excited to do it. Definitely, it takes a while to present these. I just realized too. So maybe we can change something on that and I can start this little channel. Maybe have my portfolio. Yeah. So, thank you everyone. Uh, how the fuck do I stop this? Aha.